Market Outlook webinar with me, David Jones, and Aondo Markets. If you're watching the recorded version of this, it was held live on Wednesday, February the 7th at 12:30 in the afternoon. So this is a webinar we do every week on a Wednesday lunchtime. It splits down into two parts. So we take a look at what's been going on in the markets, and we do a little bit on strategy. And today's strategy that we're going to do is talk about stop losses. Of course, there has been an awful lot going on in the markets over the last 5 days or so. So I think that risk warning's been up long enough. So let's take a look. And I think there's only one market to start off with, and it's the US market. We'll have a look at the Dow, then we'll look at the S&P. So for months now, you know, I've been joking that all this market does is go up, and of course that is all it has done. You know, since everyone expected the market to sell off in 2016, November 2016, when Donald Trump won the election. But since then it's rallied, and it rallied more than 25% since then, and it had, I think, one of the best starts to the year, one of the best months in many years. So it was all really strong. But it's the classic saying that bull markets, you know, markets that are rising, climb a wall of fear. And there was always worries that at some point there's going to be a correction. But of course, as the market continues higher and higher, everyone gets more and more complacent. But over the last 5 days or so, isn't it, is when it's really accelerated. We have had the correction. Sorry, I can't talk today. So we saw the highs for the Dow, 26,400-ish up here at the end of Jan. And what did it touch yesterday? I think this is the out of hours market. So it traded as low as 23,115. So a move from 26.7 down to the low 23s. I mean, that is a big old move. You know, it's a 10% move in about a week. So that's a pretty vicious move. I think it's really hard to trade stuff like that. If we flip it over, let's flip it over to the hourlies, because I trade lots of US stocks, so I was definitely caught when they started selling off. But you know, I had stop losses in, so any that had moved far enough, you know, the stop losses kicked in or the stop profits kicked in. But it really just sort of looked like it was stabilizing all the time. So this is the end of Jan, where it sold off a little bit and sort of holds above 25,900, only to lurch lower. Then it does it again on February the 5th. Looks like it's stabilizing, falls off a cliff. And yesterday we did have some sort of meaningful rally yesterday. It's really interesting. I think even though it can be painful to try and trade through this sort of stuff, I think it's good if it means we return to maybe more sort of normal stock markets, inverted commas, you know. So we had volatility has been incredibly low, and I'm sure if you've read about these two volatility products that have basically blown up the last couple of days, these I think accelerated maybe some of the volatility we were seeing in the market. There were these two, I think they're called inverse VIX ETFs, so exchange traded funds, and basically it was a play on volatility staying low. And you know, when volatility stayed low, as it has done for a long time now, these products would just go up and up and up. But then when volatility comes back, bang! You know, we saw these things. I think they're being closed, the ETFs, because they've fallen so much. So I think there's an interesting story on how yet again we're seeing maybe some of these derivative products magnify some of the volatility in the stock market. So But I think it'd be good if we return to more normal trading. And the question now is where next? Let's switch this over to the S&P, because I do prefer the S&P 500 to the Dow for giving us a much broader look at the US market. Here we go. So you know, it's a sizable correction. It's traded down. So going from absolute all-time highs end of January, yesterday went back to levels not seen since October last year. So giving back something like 4 months worth of gains in a little over sort of 5 to 7 days. So it's a big move. Let's take a look at the big picture. I think it's always, you know, pays to keep an eye on the trend. So if we go back, so this is 2 years ago now, February 2016. So let's just pick up on that trend line and see where we are. You know, whether this is a correction or not, let's say this is a correction and the market carries on going up. And looking at this chart here, you'd have to say, okay, it's a particularly vicious move, but that trend is still very much intact. You know, we'd have to take out the June, July lows last year at 2400 to really suggest that that trend for the last couple of years is over. So let's say you think it's a correction and you want to buy back in, fair enough. But I don't think there's any hurry to buy. I think what we've seen in the last week will have really spooked lots of people. You know, lots of people who'd got used to the market, you know, grinding up 1%, 1.5% a week. Then suddenly, you know, volatility returns with a bang. So for me, for my money, you know, maybe the next few days, the next few weeks, if we have seen the market a bottom here, then maybe the theme is going to be one of just choppy trading. You know, while everyone maybe gets their head around what's happened over the last couple of weeks, everyone's a bit nervous about buying back in just in case it's the start of a crash. Then everyone's a bit nervous about selling just in case the market's going to go ramping back up again. So I think maybe the next few weeks we'll see indecision in this market, but maybe more of a trading market rather than just a buy and hold and it goes to the moon market. Let's take a look at some of the hourly charts. Again, I think because of the volatility in the last week, I think it's hard to do a sensible trade on something like the S&P now. If you thought the market was going to recover, then the closest I would want my stop probably is below yesterday's low. You know, let's just have a quick look at that daily chart again. You know, it was only yesterday that it made a new low for the down move. You know, so maybe today it'll lurch down there again and have a retest. We don't know. But I think that's, you know, if we do see any weakness coming back in, clearly these lows from yesterday are the ones to watch. So the big level on the S&P, well, the out of hours low was 25.30 and the in hours low is, I'm assuming, around about there. Is it 25.80 to sort of 26.16? So just watch and see what happens. You know, at the moment, yesterday it trended up all yesterday. You know, if we could break out today through yesterday's highs at 2,700, you know, we could expect more of a recovery. Anyone who's still short might be thinking, okay, well, maybe this market's going to run away higher again. Let's close it out. So I think it's very much about watching the highs and the lows. But personally, I'm in no hurry to jump back in just yet. I'm quite happy to give it at least a couple of days and let's see what happens. See if it sells off and it bounces. Then I think that does build the case that the worst is behind us. But it's made for a really interesting week. But I do think for the next few days, few weeks, that just choppy markets may well be the order of the day. But there we go. It stopped being boring. I used to complain every week for months now. I think I've been complaining about how boring it is, and it's definitely not boring anymore, stock markets. Okay, let's take a look at what that meant for the FTSE. As usual, FTSE just overreacts downwards. So markets can go running away higher. The FTSE will eventually push out to new highs. As soon as there's a bit of a wobble in the market, the FTSE plunges like a stone. Again, it was a really big move yesterday. So hang on, let me flip this to a daily. Where did it go back to yesterday? I thought it went a bit lower than that actually. I think it went down to, let's have a look on the dailies. Oh, there we go. Yeah, so it did go below the 7,000 level briefly yesterday. I think that was in the pre-opening. So that was in the 24-hour market. So it did trade, traded back to levels not seen since the end of 2016. So again, the FTSE's gone from all-time highs to where it was over a year ago in the space of a week. And the process is the same. I think clearly it's going to be the US markets that dictate what happens now. So I think if there's a market to watch, it's the US, so the S&P and the Dow. And then the FTSE and the DAX will just follow those. But again, the key level for the FTSE is going to be down there, those lows, out of hours lows, around about 69.30. Let's take a look on the hourlies. It's just, again, it's like the US market, isn't it? It's sold off, it's recovered over the last 24 hours. Let's see what happens next. We'll take one last look. We'll have a look at the DAX, and then we'll do a little bit on stop losses and where we should place stop losses. Let's take a quick look at how the DAX reacted. Wow. So the DAX touched 13.6 on the 24th of Jan, 23rd of Jan, and traded as low as 11.7. So nearly a 2,000 point move on the DAX. So what's that? 15%, nearly a 15% sell-off from those highs. So a particularly vicious move. And again, I think the DAX does tend to be the most volatile out of all the indices in both directions. You know, we see a lot more volatility in that market. But the levels to watch, yesterday's lows. Let's see what happens the rest of the week. If the markets sell off, do we see those lows hold? Okay, let's talk about stop losses. Let's go to maybe something of a calmer market in recent days. Let's go to the pound against the dollar. Then we'll talk a bit about this afterwards. But first of all, let's talk about stops. So stop losses are really important because, of course, it's a way of managing your risk. And I think everybody does have it drummed into them, how important stops are. So everybody uses, or most people, I think, these days use them. I'd be surprised if there were the majority not using them. Excuse me, I've got a bit of a sore throat and I'm just pumping myself with a lemon sip. But I still think from some of the stuff I read, I still think many people get frustrated by them. And I really do think the reason for the frustration is people set stop losses far too tight. So they know they've got to set the stop loss. They'll trade something like, let's say this, pound US dollar. They might think, okay, pound US dollar is going to go up. It's currently trading at 139.08. I'm going to do £5 a point, but I only want to lose 100 quid. So I'm going to put my stop loss 20 points away. Guess what? The market doesn't care that you only want to lose 100 quid. You know, so just picking what are almost random stop losses based off how much money you're willing to lose, I think it's a ridiculous approach because you're clearly, you know, you're just going to get taken out in the market volatility. If we look at something like the pound yesterday. So yesterday was a bit of a volatile day, but not a crazy volatile day. The high for the day was 1.3999. You can see it there in the bottom left on the screen. The low for the day was 1.3836. So the market moved 160 points throughout the day. I suppose that is quite a big day for the pound, but in relation to some of the recent candlesticks, it really isn't. So the market range yesterday for pound US dollar was 160 points. So hopefully you can see if you're setting stop losses that are, I would say, pretty tight, you know, sort of 20 points, 10 points, 30 points, whatever it is, you're sort of banking on your accuracy being probably much better than it really is. So I think people set them far too tight and they get frustrated when they get stopped out and the market then goes the way they thought it was going to go. So I'd say the important thing is clearly to use stop losses, but set them in areas where if the market goes to this level, I am definitely wrong. So there's an obvious one back here. You know, this was back in the summer of last year when the pound was recovering and it's continued to recover this year. So the market sells off. This is a daily chart. We'll look at a shorter term chart in a minute. So the market sells off October the 6th and trades as low as 130.27. The market rallies up to 133. The market sells off again, blah, 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 chop, chop, chop. Let's say we're here where the market's at 132. So you might think, well, this looks like the pound is going to go up again. So you want to be a buyer at 132. But again, you think, well, I'm going to set my stop loss 20, 30 points away because I think my accuracy is that good. You know, and the risk is, well, the market goes up and then it comes off again. But the level that doesn't get taken out, you know, the really obvious level to set your stop loss is that previous low, you know, because by definition, if you think the market's going to go up, based on this daily chart, it shouldn't take out that previous big support level. Okay, so rather than trading in here somewhere and having a stop a fraction away, you know, you'd risk getting just taken out in the noise of the market. Place it somewhere logical where if the market goes beyond that level, you want to be out. There's an interesting one now. Actually, I'm going to change this to an hourly chart. So again, pound US dollar now. Let's take a look. Here we go. So pound US dollar. Where are we? What am I looking at here? So let's say you thought this market was going to go up from here, and I think it's going to go up. Maybe not from here, but I think it's going to go up. So on an hourly chart here, I think we've got an obvious level to place the stop. So I mean, you could say clearly the trend for the last what, 5 days has been down. So you could argue against not being a buyer here. But let's say, you know, somebody put a gun to your head and you had to do a trade on pound US dollar here. We've got a really big level as a reference point. Yesterday, the market traded down to 138.36 and rallied to 139.80. So we had that 150-point move overnight and earlier this morning. This morning it's traded as low as 138.73 and it's bounced back. So for me, if I was buying the pound here, I don't want to set my stop loss just, you know, 20 points away down here somewhere. I want to have it below yesterday's low. You know, it's a really obvious reference point to have my stop loss at. It doesn't mean the trade's going to work out, but it does give me a much better chance because I'm avoiding getting stopped out in the noise. You know, the market can easily sell off this afternoon down to there and bang, away it goes, and that level still holds. So it's picking an obvious level. Let's take it in one step more. Let's take a look at the 10-minute chart just for today. So that's yesterday. So again, a more aggressive trade. And I wouldn't recommend this because yesterday's low would still be my preferred thingy-majiggy, my preferred stop loss. But a more aggressive trade on a 10-minute chart. What time is it now? It's 10 to 1. So this morning at 10 to 11. So a couple of hours ago, the market traded as low as 138.70 and it's bounced about 30 or 40 points. So again, if I was a buyer now, if I was a buyer at 139.06, I wouldn't be putting my stop loss at 138.80. I'd be putting my stop loss at the very least below the extreme of the day. So I think hopefully the lesson to take from this is, I think when it comes to stop losses, don't place them randomly. Try and place them past an obvious extreme point for the time frame you're trading. You know, particularly if I look at US indices, I always look at the previous day's high and low because clearly they're important levels to watch going into today, because they're levels where if the market rallied up to a high yesterday and fell off, well, the opinion was it was too expensive up there. If it falls to a low yesterday and rallies, opinion was it was too cheap down there. So I'm a big fan of looking at these extreme levels. Let's just do one more because I've just remembered. I don't know if it's held. Eurodollar though. Eurodollar is a really big level again where it's having a little dibble below it actually, I suppose. Well, maybe you would have been stopped out, but I think it's interesting that the lows from the end of Jan around about 123.30-ish, I probably would have got stopped out on that. It's sort of it has blicked through them, but there's an argument again. Okay, let's say, because it doesn't work all the time, maybe let's say it's a false break. For again thinking, well, okay, it's blipped through, but it's rallied. Maybe it is trying to hold here. There's an argument for being, if I'm a buyer of Eurodollar at 123.48, of having a stop loss below that low from yesterday at 123.13. Okay, so again, it's picking those obvious extremes. And here, for example, here's a great example on the upside. Beginning of Feb, the market rallies. If you were convinced it was going to fall, you know, don't just go short here and place a random stop 10 points away. You know, look at the big levels where it's failed, you know, because, you know, highs and lows do show us when market sentiment has changed. So if we were going short up here, put a stop above that recent high. Okay, that's the bit on stop losses. Let's take a look at some of these FX markets now. Where's it gone? Pound against the dollar. It's interesting, this pound against the dollar. It's another market that, I mean, clearly it's different to stock markets, but it's another market that has done, you know, really well. We've seen a really strong start to the year, pound US dollar. But I don't know if I was saying it last week. I do think that maybe some of the pessimism to the US dollar has gone too far. I think last year was the worst year for the US dollar since 2003. You know, it slid really heavily on the year, and most of the market commentary I was reading beginning of January was really pessimistic for the US dollar this year. You know, so that does suggest higher prices for the euro and the pound. But I do just think that, you know, when everybody thinks a market is going to go one way, you know, and there's that consensus of opinion that it's almost free money to bet against the dollar, it's sod's law that when it turns around. So whilst, you know, I still think that pound US dollar is still strong, the recovery is still strong, blah, 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 I think maybe it's going to struggle in the short to medium term to make much more headway than we've seen over the last couple of weeks, just because, or the last couple of months maybe, just because it's got a little bit overextended here. So I think, you know, maybe the risk is in the short term, but maybe a bit more of a drift. But, you know, from the bigger picture point of view, even if it drops, what, 500 points from here, 400 points from here, it's still within that big recovery trend. So I think overall, sideways would not surprise me at all. I don't see it running off to the races. Here's our hourly chart. So there's that stop level we were looking at before. So we've got a couple of little levels to watch if we were trading over the next couple of days. Maybe it's slid enough, over the last week, and we're due a bounce back up here, then it comes back down again. I just don't see it at the moment, at least, really breaking out to these highs, out to fresh highs like we were seeing towards the end of last year and the beginning of this. So maybe we'll just see more chop, I think, for pound US dollar. But a bit of support there, 138.36, and then bigger support out here, 137.40 on the hourlies. Let's chuck some squiggles on the chart because I know some people like those. See what that looks like. But I'm guessing it's going to be all a little bit sideways. Oh, where's that gone? Pound US dollar. Where's my RSI's gone? I'm a bit under the weather today, so I'm not functioning very well when it comes to the technology. Hang on a second. Let's put a 10-day on. There we go. Okay, so maybe just a bit of chop is the order of the day for that. Eurodollar, pretty much the same, I think, again, because everyone has been so negative about the US dollar. Maybe that pessimism is overdone. So maybe we're due something of a correction in the euro against the US dollar. We've got a tighter trend there that comes in around about 122. So it could easily weather a 150-point drop from here. So this whole support level running from 121.60 through to 122, is good support. The RSI has been really overbought since the middle of Jan. That's unwinding now. So maybe we get a bit more drift and the market hooks back up and has another look at the sort of 125.30 to 50 sort of zone. I think maybe a bit boring currency markets over the next week. Let's see what happens. Let's take a look at gold and oil. So we'll look at the gold price first of all. It's interesting. I'd have thought anyway, given the craziness in stock markets, that we'd have seen gold up. But I think again, it's another example how maybe this story of dollar weakness has been overdone, because of course if gold goes up, the US dollar is going down. Here's the bigger picture chart for gold going back to 2014, and for me it's all about the highs from 2016 at 1375, the high from last year at about 1357. So it's this whole 1357 1375 area where it's run out of steam for the last couple of years. And we are seeing it happen again. It's interesting. We'd had that great run since Christmas. So, and that does tie into maybe a bit of a stronger dollar. If you sort of stronger dollar from here, we see gold drift off. So I do think it's all about these highs here. And so far, it's doing exactly what it did last year and what it did the year before, that it starts to run out of steam in that 1360 to 1375 area. Clearly, if we get pushed back to where we were just before Christmas, the sort of 1250s, it looks like a buying opportunity. But again, the RSI has not done a bad job here. We've seen the market bottom out down here, rally up, very overbought, bearish divergence, and the market bang starts to sell off. And finally, oil. Let's have a look at what the oil price has been doing. Again, all these trends, we saw strong trends in the pound, the euro, gold, oil, stock markets, all starting to stutter a bit. I mean, the stock market's clearly doing more than stuttering. So here's our oil chart. So we've had a really strong start to the year, pushing out to a 3-year high. Trend is clearly up, but again, let's just keep some perspective. The price of oil is up about 50% since the summer, near enough. Going from the low 40s a barrel to $66 a barrel. For now, at least, that trend is looking like that. Yeah. So again, I think like with a lot of these markets, any weakness looks like something of a buying opportunity. It's actually maybe one of the more interesting ones at the moment, because it is sitting right on a support level, right on the level. What's the level for oil? 62.17. So right on the level it sort of bounced off before it pushed out to those fresh all-time highs again. So there's an interesting one to watch straight off the bat there. Of course, this afternoon it's the oil inventories. So when we find out how much oil the US has got stockpiled every week that gets released, we often see plenty of volatility in the oil price. If we're looking at the RSI, and it does suggest that we are getting to the point where maybe we should see some of this weakness stopping. I would say it's not stopping yet. We've got the red candle for today. It's gone down pretty much almost every day for the last week. The market is unwinding. So I think there's going to be a bounce coming, but it's just whereabouts it comes from. But I think the levels to watch on oil, it's going to be those lows from back there, 62.78, and then if we take it out, it's going to be the 61.07. Let's call it 61. So I think that whole $61 to $63 area is the one to watch for a bounce. Let's have a quick look on the hourlies. Take a look at that. See if we can see it. There we go. So it's that old support from back there. So it's interesting, but it's still weak at the moment. If it's going to bounce from anywhere, we're here, but it's still weak. So it's not a trade I would do yet. But again, the aggressive trade is to be a buyer and put a stop loss underneath that obvious extreme point. So underneath somewhere beyond 62.75. Let's see what happens. But maybe it's still a bit weak for now. So that's it. I think that the interesting market is still these US markets. It's if the low is in, if we're seeing these markets stage some sort of recovery, then very clearly we shouldn't take out yesterday's low. Okay, that's how we look at that. So yesterday's low on the S&P was 25.30. On the Dow, what was the low on the Dow? 23,100, let's say. Okay, we'll round it up to that. So it is trading now at 24,007. So it's 1,600 points above that level. But again, as people have learned in recent days, it can move that sort of distance very quickly. But it does look, I think, more positive or less negative than it has done for the last 5 days. But the test is going to be, if we see this market sell off, do these previous lows hold? But I do think this has shaken up clearly a lot of market sentiment, and I don't think we're going to, famous last words, I don't think we're going to be seeing all-time highs in US markets anytime soon. I think there's going to be a lot of nerves out there, so it'll be quite a good trading market and less the sort of buy and forget about it market it has been. We'll start wrapping things up there. Thanks very much for coming along. It's been a really interesting week. I hope the stuff on stop losses has helped. Sorry about my voice being a bit croaky this afternoon. If you have any questions, drop me an email. It's david@jonesdc.com. No, that is one, but I can't even remember my email address. david@tradeafter.com is the best one for market stuff. And you can follow me on Twitter @JonesTheMarkets for interesting charts and stuff like that during the day. But we'll wrap things up there. Thanks very much. And let's see where we are in a week's time.